Stocks staged an impressive rally today as we started the morning down fairly significantly as we had some more concerns about joblessness. But as the day went on, we had a little bit of a dash for trash in some of those areas like the financials that have really been left for dead here recently. So we'll see where this takes us, but fortunately we are catching a bounce right at that rising 30-day moving average for the S&P 500. So we'll take a look at all that, see what it means for our posture. Then we'll get into our trade application example where I wanted to talk about a stock that's been up for the last 2 days and is now in the midpoint of its recent sideways trading range. So I thought it might be a good opportunity for an iron condor. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's May 14th, 2020. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe, and while you're over there, check out our description area where you can sign up for our email distribution list. That will put you on our list in order for you to receive our daily notifications when these videos are ready to be viewed. In addition to that, we also will send you what stocks within the S&P 500 are giving you overbought or oversold cluster signals. In addition to that, we're heavy users of Twitter. We really appreciate those of you that click like for us on these market outlook related posts. You guys did a great job for me last time around, so thank you for everybody for stepping up there. Please continue to do that. And then lastly, we do have a presence on Facebook as well. You can join our group at the web address embedded in the logo in front of you. All right, let's jump into our charts here tonight. As you can see, I've got chart 6D pulled up here in front of us. It used to be a rarity that I'd bring this up to begin my session, but for the last 2 or 3 months, it seems like it's more of a normal occurrence, of course, as we've had a lot more volatility, and I try to bring up this chart whenever we have at least a 1% move. So that did happen today. Fortunately, for those of you that are bullish, it happened to the upside. And you can see we finished up by 1.15% on the S&P 500. So you do see that green line plotted here in the middle of your chart, and it did go up and over that blue line there to give you a sense of how many days recently we've had at least a 1% move to the upside. Remember, if you see the red lines going down below the blue line, that tells you how many days we've had at least a 1% sell-off. So we're out of those extreme ranges that we saw in mid-March. Nonetheless, this is still an above average volatility period that we find ourselves in. With the markets being up today, naturally the VIX was down a touch, but we remain at a historically high 32 on the VIX here, as you can see kind of in the purple down in the lower right hand corner. So the VIX has really been dropping from about 84 all the way to 32, and that has been an excellent opportunity for those that are willing to sell options contracts. Now, of course, I teach a class on Fridays called Options for Long-Term Investors, where one of our focus strategies is selling puts. And like I've been explaining to my students since March, these have been elite times to be a put seller. Not only do you get the benefit of watching, some high-quality stocks rise off of extreme lows that we saw a couple of months ago, but you also have the benefit of watching the VIX drift lower. And if you had sold premium in the past, that premium is coming into your portfolio at a quicker rate as the VIX goes lower over time. So for those of you that are premium and plus members, feel free to join me tomorrow morning as we'll be having that conversation as well. Let's go ahead and now take a look at our traditional 4 grid now. This will be chart 4B. Here we can see if there's been any sort of changes to make you aware of here recently. And I think the thing that is most important, you probably heard this from David last night as well. I didn't get a chance to listen to his presentation last night. I'm sure it was masterful, but what I can say is that since I was last with you on Tuesday, there has been a change in posture here on the Dow Jones Industrial Average. On Tuesday, we were sitting with this candle. We were just barely above that rising 30-day moving average. The very next day, which would have been yesterday, we had another sell-off. That did push us from this green background color to this pink background color, telling us that we now have a bearish posture on the Dow Jones Industrial Average. Remember, that occurred when that green intermediate line on the market forecast technical indicator fell out of the upper reversal zone. So you can see right now it's at 77 and falling. So since that's below 80 and it's falling, we now consider that to be weakly bearish. Here's the good news. With the move higher today, the Dow Jones actually led us higher today. Remember, there's a lot of financial companies in the Dow, so it is a little bit more of an influential sector there. when we had a big rally out of that beaten down sector today, it helps the Dow Jones a bit more than some of these other areas. So you can see that with the big rally today of 1.62% to the upside, we did push up and over that moving average again. It's hard to see here. I recognize that. So let me just right click and maximize that cell so you can see it a little bit better. Here it's quite a bit easier to see when you've got the full screen view. And you can see that where we ended today's candle was clearly above that moving average. Remember, yesterday it was not, which is why that moving average back there turned yellow, because the moving average was still rising, but price closed below it. Today, that moving average continues to rise, but the price of the security, in this case the Dow Jones Industrial Average itself, did close back above it. So we'll keep our eyes on that and see if it can kind of stabilize around those areas. The S&P 500 is even in a healthier position there because it did not lose its bullish posture. Came close, but not quite there. And so we did have a couple of days of pullback here, Tuesday and Wednesday. Today we were selling off in the morning, but we recouped all of those losses and then tacked on an additional 1% beyond that. So, we continue to have the strongly bullish posture on the S&P 500, and we've continued to have that green moving average there as well, telling us that this entire time, going back here to this candle on the 23rd of April, we have closed above a rising moving average, and that's generally perceived as a bullish instance there. And you can see here that the market sentiment line is also providing some bullish posture. It's at 39 and rising. That's a longer term look back period than even the intermediate line. So that's a positive situation there as well. And then of course the Nasdaq Composite, we are still seeing this as a Nasdaq-led rally. This is a situation where the Nasdaq has a lot more technology-oriented firms in it, and you can see there is quite the difference here in terms of compare and contrast. From a year-to-date perspective, you can see this year-to-date label right here says minus 0.32 on the Nasdaq Composite. So in other words, it's basically flat on the year. Whereas you look at the year-to-date ranking on the S&P 500, it's down 11% this year. The Dow Jones is down 17% this year, and the Russell 2000 is down 25% this year. So with the Nasdaq Composite being effectively flat, that is impressive. Remember, there are thousands of companies on the Nasdaq Composite. If you're ever trading the QQQ, that's a slightly different product where it's only concentrating on the 100 largest non-financial Nasdaq components. But this Nasdaq Composite that we look at during this video is actually a much broader scope of things. And so it makes it even more impressive that there's that much difference in the returns compared to some of these other big indices that are out there. One of the things that I tweeted out last night, I had noticed that somebody had liked a tweet of mine from back in January, and quite frankly, I had forgotten I had even put that particular tweet out there. But it was just a pretty basic tweet of 24 of the strongest stocks in the Market Scholars 1000. I think this was back on January 19th or 20th or something like that. Of course, at the time, I had no idea that the coronavirus was going to come out and pull the rug out from underneath this market. But I was merely pointing out that, hey, this is the ranking system that I use for my top-down trend trading class for my Monday premium members. And I went back and calculated them because I saw some very impressive names on that particular tweet, including things like Dexcom and Shopify, and some others that have continued to, impress to the upside. And the vast majority of them were NASDAQ components. And they were up about 4.9% as of last night's close. The S&P 500 was down 15% over that time period. So again, it's not that that's going to work out every time, but what we found this time around is that if you had concentrated your portfolio on technology-oriented companies prior to the coronavirus downdraft in the market, you've actually been able to withstand the pressure of that drop in the stock market much better than folks that were concentrated on some of the weaker sectors of the market back in January, like the financials or energy or what have you. So I found that to be pretty interesting. If you're interested in that tweet, again, that was last night. Just go to my timeline and you'll be able to find what other 24 stocks were part of that group besides just Dexcom and Shopify. All right, and Teladoc, by the way, was another one that I noticed that was on there. Teladoc was down today, but has had a heck of a run and, of course, has actually benefited probably from this coronavirus since January. Before we leave this view, I did want to point out that the Russell 2000 again underperformed today. It had less than a 1% move, and as you can see here, it does have a bearish posture just like the Dow Jones Industrial Average does, and it also has that green moving average. In other words, we had enough of a rally here at the end of the day for the Russell 2000 that it did still close above its rising 30-day moving average. At one point this morning, that was not the case. So I think that the summary and the takeaway is this was actually a pretty legit rally that we experienced in the market today. A lot of you have been kind of listening to David's commentary on gaps and where do the impressive moves get made? Do they get made in the after-hours session with the futures, or do they actually get made during the day? This was one of those rare instances where you had a significant move from low to high that happened pretty much all in the normal hours of trading today. So, tomorrow is an options expiration day. Remember, the May monthly contracts roll off the books tomorrow, so there is that potential for some pinning that might take place. And some stabilization as a result. It's possible that they're just trying to keep this market elevated here for the next couple of days, and then they start hammering you again early next week. So we'll have to be on the lookout for that. But hey, we'll take what we can get at this point with the economy in shambles the way that it is. The fact that the stock market still hasn't capitulated back to the downside is a promising sign. All right, let's go ahead and now take a look at our 3 green arrows chart. And this will be chart 4D for those of you that are following along at home. Here we don't really have a whole lot to report. The one thing that I would point out is that the Dow Jones Industrial Average no longer has a 3 red arrow signal. Yesterday it did when it gave you that red arrow on the moving average, because it already had a red arrow on the MACD histogram and also a red arrow there, a phantom red arrow on the stochastics. So there is one thing that I can point out to you today on this particular view, and that is with the Dow Jones closing back above its moving average, you did get that green arrow back there. So where it stands right now for all 4 of our charts here is that we do have a mix of green and red arrows across the board. Even on the leading area of the Nasdaq composite, you still have a couple of red arrows there. In fact, you got a brand new red arrow on the stochastic for the Nasdaq composite just today. So right now there's conflict, right? And that happens a lot. There's not typically these obvious moves up or down. A lot of the market's movements are just chop and slop sideways until we find a breakout here or there. So right now, there's still some optimism that the breakout can be to the upside because the moving averages are still moving to the upside, and they're all still green in this particular case. So, a lot of folks will look at the economy and say, well, how can the stock market be doing as well as it is? Part of that is because of the stimulus that's being pumped into the system. And it doesn't make a whole lot of sense, and I get it. I've certainly questioned it myself, but the truth of the matter is prices are holding up, and we should do our best, particularly if you're an active trader. If you're a long-term investor, there's a little bit of difference there, but if you're an active trader, you should trade what you see, not what your gut is telling you, because a lot of times your gut will lead you astray. So right now what we're seeing is that markets are still more robust than a lot of people believe they should be, and they're still trading above rising moving averages, and therefore the path of least resistance continues to be to the upside for the time being. All right, let's go ahead and now take a look at our 1040 crossover method chart. That's chart 4C for those of you that are following along at home. All right, now as I look at this, I'll point out just one thing that I mentioned last week as well, and we don't need to spend a lot of time on this chart setup because it does move very slowly. This is not a very sensitive chart because we're using weekly candles here, and each one of these charts goes back 3 years in length. But I'll just reiterate what I mentioned last week or the week before, whenever it was, which is the Nasdaq is the only one that is different out of this entire group here. You can see the Nasdaq currently has a green background color, and that signifies the fact that the orange line is now back above the blue line. So if I were to right click on that and maximize that cell, you can see it much more clearly here where this orange line, which represents the 10-week moving average, has crossed up and above that blue line, which represents the 40-week moving average. And since the more sensitive line is crossing up and through the less sensitive line, that is telling us that the price momentum of the Nasdaq continues to be to the upside. Now, you are obviously receiving positive price performance in the other indices as well. It's just that it is not going up at the same pace as the Nasdaq. So with moving averages being lagging indicators, you're just not seeing the crossovers taking place there yet. So you actually have a lot of work to do. And again, this is another view that really shows you the utter dominance of Nasdaq stocks right now compared to the rest of the market. Normally, these things are going to be pretty uniform. I mean, if you look back at the last time we crossed from bearish to bullish, you saw that the S&P 500 did it back here in late February of 2019. If you look at the Nasdaq, it did it in late February of 2019. If you look at the Dow Jones, it did it in mid-February of 2019. Now, the Russell 2000 was a little bit of an oddball then, but it traditionally is a little bit more the case because it deals with a completely different class of stocks. The Nasdaq Composite, the S&P 500, and the Dow Jones Industrial Average are really driven by mega cap companies. The Russell 2000 is not. So if there's ever a difference, it's usually coming from the Russell 2000. This time has been different. This time really is. With the Nasdaq Composite, you are basically seeing that a different class of stock. It's really driven by a technological stock, a technological innovation, and a lot of that is driven by work from home, where a lot of people need new setups, whether it's Logitech, with new webcams, whether it's software companies to support videos like this, whether it's our premium classes. Cisco came out last night with their earnings announcement, and the stock was up nicely today. With our premium classes here at Market Scholars, we use WebEx, which is a Cisco product. So there's a lot of these technology companies. I mentioned Teladoc before. Zoom is of course a stock that we've traded in this presentation before. So a lot of those types of companies are actually benefiting from this move from the office into the home. And so that's allowing the Nasdaq Composite to retain that strength. And also remember, there's a lot of biotech companies in the Nasdaq Composite as well. So if you're looking at companies like, here, let me right click on this and I'll show you like Amgen has done reasonably well, right? That's a big biotech company, a very well-known one. AbbVie has really sprung to life here recently. I've been tweeting about that one this week. Now that the Allergan deal is made official, AbbVie has been off to the races this week. And you're going to have companies like Vertex Pharmaceuticals. This is a company that we own in my Monday top-down trend trading class. That biotech-oriented company has really taken off to the upside. So those companies have done reasonably well, and it's not just technology driving us higher. You're finding a number of these Nasdaq-oriented biotech firms that are really leading that charge to the upside here as well. All right, let's do some 12 grid analysis now, starting with 5A. This will be our asset class 12 grid. And here, I did want to point out something that I've been kind of cheerleading for a while, so you'll have to forgive me there. Sometimes I get a little excited about things, and some of you that have been watching this presentation will know that I've been kind of sticking my neck on the line for gold and pushing more and more trades into gold than I traditionally would for somewhat of a niche asset class. But I really liked the price behavior for gold, and as you can see here, we had another beautiful day. I really love how this is trading right now. GLD was up not quite 1% today, but you can see that was a pretty nice looking candle there. And I've really liked the constructive price action over the last 3 days. Remember, the last 3 days from a stock market perspective have been 2 really terrible days to the downside, followed by today, which was a nice day to the upside. The last 3 days for gold have all been up, and today was the best of them. In fact, we are on the cusp of a legitimate breakout here in gold. So this is the type of constructive behavior I like to see, where most of this bottoming effect is taking place above a rising 30-day moving average. So I don't want to jinx it. Sometimes I have the the ability to do that, it seems, but I must say I really like the way that gold is shaping up here. and I'm really kind of hoping for a big breakout here in price behavior either tomorrow or early next week if things keep on trending along the way that they are right here. This is actually your second best closing price on GLD in the last 3 months. The only day that surpasses it was this candle back here on the 23rd of April, where we closed at 163.34. So in other words, 33 cents above where we're at right now. All these other candles, while you had a couple on an intraday basis that were up and over these levels, they didn't close there. So this was an impressive close to me on a day where gold probably wasn't the storyline of the stock market. The storyline of the stock market was really more in the financials as opposed to some of those gold companies. So it kind of took a back seat from a headline perspective, and I don't mind that. Sometimes you have too many people jumping in the boat at the same time, then the stock market does its best to frustrate everybody. So I don't mind the fact that this was a little bit of a quieter story today, but I really do like this price action that's shaping up here in gold. And some of those gold miners like Newmont Mining, this is one that we did a recent trade on, not only here in this presentation to the upside, but we also did one in our swing trading premium class, and that broke to new highs here today as well. So some of those gold mining stocks starting to benefit to a degree there as well. So keep your eye on gold as the takeaway. If you've been watching these presentations in recent weeks and months, it'd have been hard to avoid that, but just pointing out that it continues to work. So if you're going to press your bets into strength, that's one area where that strength exists. Other things to be aware of from this particular 12 grids perspective is, it's interesting again to see the difference in the foreign stock markets out there. Right now, I kind of mentioned this on Tuesday as well, but I'll just reiterate it. Right now, what we're seeing is that there is more strength in the emerging markets as opposed to in the developed foreign markets. And while that's not going to be the case country by country by country, from a general perspective, that is taking place. You can see that the EFA here has a pink background color, telling us that we have a weekly bearish posture for the developed foreign stocks, whereas we have a dark green background color for EEM, which is telling us that we have a strongly bullish posture for the emerging market stocks. One emerging market stock that has kind of caught the growth world by storm. There's been a few of them, but one of them that has really been impressive to me has been Mercado Libre. This is kind of a quasi eBay / Amazon / PayPal down in Latin America. So whether you're shopping online in Brazil or Argentina or what have you, there's a good chance that Mercado Libre is going to be one of those websites that you're visiting as opposed to going directly to Amazon like we tend to do here in North America a bit more. So Mercado Libre had a beautiful gap on their earnings announcement and has continued to have persistent strength since that time. I mentioned Shopify earlier as well. This is actually a Canadian company. Some of you might not be aware of that, but this has been one of the great growth stocks of our era. And you can see the excellent trend that Shopify has been on there as well. One kind of company that I've had my eye on even for this particular market outlook presentation to possibly do a bullish trade on, but what has kept me back so far is that it's got earnings coming out, and I don't really want to step in front of a potential bust, right? So I'm kind of holding off on it, but one that's been on my radar for the last few weeks has been ZTO. This is actually a Chinese company. I know it says Cayman Islands up here. That's just kind of where it's registered, but this is actually a Chinese company, and of course China is part of that emerging market space as well. But this is a beautiful trend here, and this is kind of like a UPS or a FedEx type of a company over in China. And that stock has been quietly just, lighting the world on fire. Nobody talks about it. It's not a very popular company. But if you look at this chart here, you start wondering why. I mean, this is a great looking trending chart here for ZTO as well. So anyway, some interesting foreign stocks out there that are trending as well. I know we give a little bit more press to the US based companies during this presentation, but we gotta give credit where it's due in this case with some very impressive foreign stocks as well. Let's go ahead and now take a look at our sector 12 grid. This is chart 5C here in this case. This is the US sectors. And you can see that we had a pretty broad-based rally here today. Really, let me just verify before I say it wrong. Yeah, the only one that was down today was the consumer staples. It was down 0.25%, so not even a terrible day there for the staples. Real estate was down earlier in the day, but just by the end of the day closed a hair higher there. Otherwise, we had some pretty strong performers, and the one that I wanted to really emphasize here was the financials, right? The financials were up 2.5% here today, and remember, they had been just really left for dead. I mean, you saw some major reversals in banks here today. Wells Fargo has been in the news a lot because it just seems like it's a downward train that never ends. Well, they had a heck of a reversal today. They were up 6.79% as there were some rumors floating around that Goldman Sachs and Wells Fargo might consider a merger of sorts. And Goldman Sachs, I think, finished higher today as well. Not as much, but still good to see them up as they are an important company that's in the Dow Jones. Another stock that, of course, we've had some interest in this presentation is Discover Financial. That's the one where I took that speculative trade where we bought those Leaps calls. It was up 7.8% today. But they weren't alone. There were tons of companies that were doing better today. U.S. Bank was up about 6% today. Bank of America was up 4%. Citigroup was up 3.6%. JP Morgan was up 4%. So we're going to keep our eye on that. Most of those particular trends are still to the downside. So while today was an impressive rally, it doesn't mean the trend has changed. It could just be a situation where they ultimately have good bearish trading setups once they kind of reset their prices a little bit higher. But thought we'd point it out here in the session tonight just simply because it was kind of eye-popping and stood out in the crowd compared to what we had been seeing typically out of the financials. So that was your big winner here today in the market. You will notice that healthcare had a pretty solid day. It was up 1.1%. And healthcare remains one of our stronger areas within the market. You can see that it remains above a rising 30-day moving average and continues to have that dark green background color there, telling us that we have a strongly bullish posture. There was one stock that caught my eye today as we transition now into our trade application example. One stock that I kind of liked the way that it was acting for the last 2 days, not just today alone. So let me come over here to chart 3A, and I'm going to pull up a very well-known healthcare company, Merck, ticker symbol MRK. And so as we look at Merck's chart here, you can see that it has been an outperformer versus the S&P 500 over the last 3 months. The S&P 500's dotted line is down below the price action of Merck here more recently. And that has largely been the case. If there's been a decent place to hang out, I mentioned technology before, but right there next to technology has been healthcare. Healthcare has been an okay place to be for bullish trades during this coronavirus world that we're living in. So it's not necessarily the outperformance that led me to Merck tonight. It's really the impressive rally that it had on a back-to-back day. You'll see here that Merck actually closed higher yesterday. Remember, the stock market got clobbered yesterday. I think Merck was the only stock in the Dow Jones 30 that actually closed in the green yesterday. So there was already a little bit of a heads up that, hey, there's a little bit of stability in this company compared to others. And then it followed through nicely today where it was up almost another 3%. You can see it was an impressive day. Not only did we get the blue background color, which is a bullish near-term posture for that blue line on the market forecast, but we also had price close back up above that rising moving average. So notice that the moving average had been yellow for a couple of weeks, and then today for the first time went to green. So where we stand right now is back in the middle of the range. You'll notice that we have kind of a pretty strong resistance area up here around, let's call it, 83 or 84. And then we have a strong support level down below here at around 75. And where we stand right now is pretty much dead smack in the middle of those two ranges. There might be a slight tilt to the upside as we've got our current momentum heading higher. And you can see some constructive behavior on that near-term line down below with higher highs and higher lows as well. So in a case like this where we have a stock that is trading at the midpoint of its recent price range, it might be a worthy candidate for an iron condor trade where you're selling both sides of the chart. You're selling the upper half away and you're selling the lower half away. And what you're hoping for is that the stock largely stays within that range where it is currently at the midpoint of right now. Now with Merck, it was interesting because I was looking at a couple of different variations of iron condors here today. And really, depending upon your perspective, you could either be a little bit more bullish with it or a little bit more bearish with it, depending upon where you thought the stock was going to go. What I chose to do in the end was become a little bit more nervous about the top side. In other words, I'm going to push our sold strike on Merck a little bit higher and have our sold strike on the bottom, so our sold put spread, a little bit higher than normal. But if you're somebody that has the opposite viewpoint than me, where you think you need more wiggle room on the bottom, that spread is available at an attractive price as well, where you could sell the 85 call and push your sold puts down to, I think it was the 70s. So I just wanted to point that out in case you have a slightly different view of how you want to handle a trade like this. For me, I see the rounding of the corner right here and a little bit of upward pressure on this, where I want to be a little bit more careful, give myself a little bit more wiggle room in case this gets a little bit too bullish for us in the next month. But if you're somebody that thinks the whole stock market's about to get rocked to the downside, you might choose to do slightly different strikes. So let me show you the strikes that I whipped up here. I'm going to do the June monthly contract. So those are the ones with 36 days left until expiration. And on the call side of the ledger, I'm selling the 87.50 calls, and I'm buying the 90 calls as part of that sold call spread. On the put side of the ledger, I'm selling the 72.50 put, and I'm buying the 72 put as the sold put spread side of the ledger. So remember, if you're newer to iron condors, what you're hoping to have accomplished here is that the stock stays somewhere between the two sold strikes. So for our purposes, we want the price of Merck to stay between 72.50 and 87.50. And if that happens, then I think we're going to be in some pretty good shape there. You can see that the credit that we would receive in this case is 57 cents, and that is right at a 30% return on risk if you were to divide 57 by 193 right here. And so our break evens on this, you can see if you factor in the credits, would be 71.93 and 88.07. If you wanted to see where those were on the chart, let me go ahead and pull those up here. Let me get my drawn items out, and I will show you that if I go over here to a horizontal line item, I'll draw one on the upper side, and then I'll draw another one on the bottom side, and then let's adjust those with our specific break-evens. On the top side, it was 88.07, and on the bottom side, it was 71.93. And if I hit OK, you can see the wiggle room that we have. So right here, where we're at right now, is pretty much dead smack in the middle of this upper range and this lower range. This would allow for a breakout to new multi-month highs on Merck without us necessarily getting ourselves into trouble. It'd have to go a couple of dollars even higher than that. But on the downside, we can't afford to have this stock go back to its lows back here in March. Now again, if you would prefer to structure this a different way, you could get this bottom line to come down here closer to 85, and you could push this bottom line here to be down here closer to, let's call it, I want to say like 70 or 69 or somewhere along the ways there. But for our purposes, we're going to be a little bit more cautious on the upside here because we did round the corner. We're getting a little bit of bullish momentum on this healthcare name, where healthcare has been a market performer or overachiever, and we'll just be careful on the upside as a result. All right, let me go ahead and place that trade here, and we'll see if we can get filled on that first thing in the morning. Thanks for joining me here yet again today. Remember, David will be capping the week off with you tomorrow. If you got value out of tonight's video, the way that you can encourage us to do these videos regularly is by going over to Twitter and clicking like for us there. We certainly appreciate that, as it allows us to get the word out about our company to a much larger audience than David and I would be able to on our own. So thank you as always for those of you that do that. I'll see many of you in my options for long-term investors class tomorrow morning. If I don't see you then, have a great weekend, and we'll see you all next week. Take care, everybody. Bye-bye.